Hello and welcome to Know Your Company. It's a show, of course, which gives investors hopefully powerful and actionable insights into the fundamentals of a single listed company daily. Today we're going to track HPCL, and with me is Mihika Barve. And of course, she tracks oil and gas quite closely and therefore will help me break this one down. In terms of what the company does, you've seen petrol pumps of HPCL across the country. And we have those dotted even in the remotest of areas like Spiti, etc. as well. We find HPCL pumps, and therefore it's the third largest Indian refining company in total sales, but also one of the largest distributors of oil. In terms of refining though, it owns 2 refineries in Mumbai as well as in Vizag, and it has around a 22,000 plus strong nationwide retail outlet network. It distributes its oil across this retail network and thereafter retails it to the end customer. You'll find these dotted across the country, of course, from Leh all the way to Kanyakumari. You'll see that across the board. So HPCL, very clear on what it does. It does oil and gas distribution. Now, in terms of what it is, let's dive deeper. It's an integrated company involved in the entire value chain. So it acquires oil, refines it, thereafter distributes it. So the acquisition of oil, if oil prices were to go up, therefore the profitability starts to get impacted. Currently, oil prices have sunk and therefore positive. And that's why the company is in focus, and hence we're doing a KYC on it. Now, in terms of markets and sells diverse range of petroleum products, not just your petrol and diesel. It also has a growing presence in oil and gas exploration as well as in the renewable space. It's ancillary to what it does, and therefore oil and gas distribution will oil and gas exploration will likely allow it some more leeway with regard to profitability, some more certainty with regard to profitability, because currently its profits depend on crude oil prices and refining margins, which Mihika will explain in better detail. So, Mihika.
You always have GRMs, the term GRMs thrown at you by the companies. It's in their financial results as well as analysts. This stands for gross refining margins. Now, refining margins is basically the value that a certain petroleum product has which is produced from 1 barrel of crude minus the actual crude oil cost. So this is when you have lower crude prices, it actually benefits the refining margins, and then this has a follow-through effect to the marketing margins. Now these are not revealed by the company, but you do have analysts who closely track the company naming them. The revenue from selling your products, which is mainly your petrol and diesel, which is widely tracked, minus the refinery production costs. And now, like we all know, you have petrol and diesel prices that are currently fixed right now. So lower the prices of crude, it kind of follows through. Now, in terms of the kind of risk that the company may be facing right now is, like I said, petrol and diesel prices are currently fixed at the pump. So the volatility in crude prices is what has an impact on their refining margins and thereby their marketing margins. And this could be hurt if crude prices rise. And it's also key to note that the government just yesterday has hiked the excise duty, which is a duty that the central government charges on a company like HPCL, and this excise duty is actually calculated and included in your petrol pump price. However,
this is for refiners.
Yeah, this is for refiners.
Just trying to clarify that.
It's a marketing company as well, right?
Correct.
So this actually has an impact on your petrol price.
Correct.
It has an impact on your marketing margins, but we as consumers will not have a price increase. It will actually be undertaken by HPCL. The second thing that's very key to understand is LPG losses. Now, currently, HPCL and the other OMCs have to sell their LPG cylinders at a subsidized rate, which is lower than the cost of making these LPG cylinders and what's inside them. And till now, in 9 months FY25, HPCL specifically has seen losses of 7,600 crores. However, yesterday the oil minister said that the same excise duty I currently talked about will be used for the compensation of such losses, and it's not new. OMCs have gotten compensation for their LPG losses back in FY23 as well, but it did not come through in FY25. It was expected in the budget, but the company does need this in order to insulate itself from the heavy LPG losses that it's currently facing and could face going in the future. But Harsh, it's time for the KYC ratings. Why don't you give the viewers of what we're going to analyze?
Absolutely. Let's do that. Let's quickly look at what we'll analyze on this one. We'll have the income statement, the balance sheet, the cash flow, return ratios as well that we'll analyze. We'll also look at shareholding, street cred, and street coverage. But outside of that, we'll also have a look at the valuation picture. So we'll look at all of these when we're analyzing this one, HPCL. Meeka, start off with the income
Let's start off with the income statement. It's a little trickier because it has seen volatility. Now, I want to go with just the revenue, EBITDA, and net profit numbers. EBITDA margins, while it's something you usually look at for a company, for something like an HPCL, that's not what you look at. So revenue, in terms of the 9 months FY25, you've seen a growth 2.3% uptick. This is higher volumes and even a certain hike in petrol and diesel prices like you've seen during the financial year. However, EBITDA is what's taken the hit. You've seen volatility in the gross refining margins as well as marketing margins because your oil prices have been volatile this year. That's why on a 9-month FY25 basis, EBITDA is down 46% and even their net profit is down 66%.
How much of this is impacted by LPG as well? Because you suggested around 7,600 crore of losses.
Is losses. So it's kind of offset whatever profit it would have actually met. This is kept in a separate buffer.
But this would have been much better off.
Much better off if LPG compensation had come.
So likely if that LPG compensation were to come, Meeka, this number will change.
Yeah, and it's widely expected to come because it's gotten that in the past. But from a 3-year basis, and it's key to know that FY23 was one of the years that all the OMCs faced heavy losses despite that kind of, downtick in revenues then. You've seen over FY21 to 24 revenues growing at a 36% CAGR, EBITDA at 24%, and net profit at 17%. And that's why we've given a neutral rating on this one, but it's key to know their integrated margins. Now, integrated margins are your refining as well as your marketing margins blended. Now, in Q3 FY24, 7.4 rupees per litre. Q4, you've seen 8.8. And you've always seen a kind of a volatility. Q3 FY25, it stood at 12.5, which is in the super normal range. Q4, you saw some correction. Prices have always been volatile for oil, 10.1. But it's actually Q1 of FY26 that the companies are again witnessing supernormal margins. So in terms of, while they do stand very high and higher than what we've seen even a year ago, because of the volatility of earnings throughout any quarter, we've given Hindustan Petroleum's income statement a neutral rating. But Harsh, what does the balance sheet?
Sorry, Q1 FY26, you were suggesting that it will get better.
Yeah.
But also want to point out this excise hit that they will take. Will that knock off the possibly better margin they would have made in Q1? It
does have some impact that because they're going to absorb that ₹2 cost, so that increases.
Correct.
And furthermore, it all depends if prices sustain. Because if prices continue to trend lower, then you have inventory losses. Because in Q3, Q4, you've seen them buying oil at a much higher price because at that point that was a cheaper rate. But now we are hitting 4-year lows left and right.
So what I'm trying to say therefore is, should you keep higher hopes from Q1 FY26?
For now, the ₹2 excise duty does have an impact, but they're still so maybe a 13 rupee margin, they're going to an 11 margin, which is still an uptick sequential.
Sure. Point taken. Okay, let's go across to the balance sheet. Let's quickly look at how the balance sheet is stacking up. When you're looking at equity, largely flat, when you're looking at it from a 3-year perspective, that increase just seems to be an increase from a perspective of bonus shares, stock split, etc. So therefore, no real change per se from an equity standpoint. Let's look at reserves and surplus as well. There you go, fairly steady in that sense, even where reserves is concerned. When you're looking at debt though, and this is where it starts to really become important. The debt picture, the borrowing number has increased by 1.5x. And is this the correct way or the best way to look at it? I'm not so sure. So the way we rather look at this number is EBITDA to borrowing. Whether my EBITDA growth is matching the borrowing growth. And we've seen a 50% roughly EBITDA growth from FY22 to FY24. The borrowing number also has gone up in the same kind of clip, and therefore we've given this a neutral. This is the real key number to look at, Mihika.
And it's key to note that why borrowings have gone up, because they had a capex. They're building
Correct.
a Barmer refinery, which has over around 53,000 crores of capex spending that has been put in. So that's something you need to realize. But that's why you've seen that borrowing number seen an uptick, but you need to see how EBITDA and borrowing have grown, like you said.
And borrowings also because of subsidies, right, Mihika, to a certain extent. When you have those large subsidies which are pending, you'll park some of that within the short-term borrowings on the liability side. Those assets will get parked. And that's the other piece. But let's look at cash flows. And cash flows, we'll just look at the 3-year CAGR. And the most important metric here is the cash from operations which are coming through. Everything else will likely not be the most important. And therefore, when you're looking at cash flow from operations, and we'll focus in on only this one number, it's around a 11% CAGR growth that we've seen from March of 2021 to March of 2024. So that number looking okay-ish on a 3-year CAGR basis, not bad. Of course, there's been some capex, some fundraising due to various activities, and therefore your net cash flow is negative currently. But this is the key number that we'll want to focus in on, the cash flow from operations, which has grown fairly okay for a PSU in a price-regulated environment where your prices are fixed and therefore profits are largely going to be capped.
And we've not seen, since 2022, we've not seen prices change every day. And even your operating cash flows, net on net, they stand higher than what they're investing as well.
Correct, absolutely. Let's therefore look at return ratios.
Yeah, let's look at your return ratios. Now, there is volatility even there, and we've seemed to establish that. FY22, let's see, your return on common equity stood at 18%. It took a dip in FY23. Like I said, there were losses experienced by the entire space, but we did see supernormal growth in FY24 because there was a high recovery in terms of your losses at 41%. Return on assets, they stood at 5% in FY22, dipped to -4% in FY23, 9% in FY24. And then return on capital employed, you had 13% in FY22, FY23 does not come into consideration in this space because of the losses, FY24, 28%. So there's been a lot of volatility, and it's also key to, you also have to take into consideration what the picture will look at as the FY25 numbers come in place. So you've given a neutral rating in terms of return ratios, while they are healthy return ratio metrics when they are positive, but because of the volatility over the years, it's a neutral rating on this one.
And will this always be volatile, Mihika? That's really the key question.
Yeah, but that depends on if they are in a capex cycle, how are crude prices playing. There's so many moving factors, as well as demand when you have renewable energy coming in, but demand doesn't seem to be as serious. They're seeing volume uptake. But I think we should go to the shareholding. Well,
one piece here, Mihika. So on return ratios, why are we ignoring the FY23 number? And I'm covering this only because we've not flashed it anywhere as part of our graphics. But the FY23 number has a loss. So there's a 9,000 crore loss on a standalone basis, which HPCL has made in FY23, which is why you will have a negative return ratio, or therefore return ratio ROC not applicable. But otherwise, you'll see these fluctuating return ratios, because there'll be bouts of profitability followed by losses. So this is par for course for a company like this. If you're looking to invest in a company like this, this is something you should expect and anticipate in any case.
That's right.
But yes. Mihika, quick check with regard to shareholding. 55% government ownership, that remains quite solid. The DII is held around 15%, now hold 22% nearly. FI holding has gone down, as is always the case when DIIs increase their holding. And the retail participation has gone down slightly. So largely, this is why we are giving this a thumbs up, because there's fairly steady government holding. No divestment expected either. And therefore, you're going to see a steady state on the shareholding front, and hence a thumbs up. Let's look at how the stock has moved, actually. And in terms of the way it's moved, we've had a very muted sort of performance on the counter. 1 month, of course, we've had very good move given the way in which crude has moved. And a lot of the movement in the stock price will depend on crude. Mihika, please correct me if I'm wrong. But 11% in the last month. The year-to-date number, though, is more muted, a negative 12% number. The 1-year returns are 17-odd%, and the 5-year returns are around 162%. So it's been a 2.5 bagger in that sense in the last 5 years. Now, in that sense, it's a neutral, because when you're looking at the way in which the stock price moves, it largely moves in line with crude, and it's been a fairly flattish kind of move, at least on the year-to-date period, rather negative 12% year-to-date and just about 17% on the last 12 months. So, given the volatility, we'll give this a neutral on that count. Nika, street coverage.
Very widely tracked. You have over 30 analysts tracking the stock. You have 64% of the analysts that actually track the counter have a buy call. So 22 analysts recommend a buy, 5 recommend a hold, and only 7 recommend a sell rating on this counter. In terms of the return potential, you do have a 14% return potential for HPCL. So it's a thumbs up on this one. It's widely tracked. You do have the street more bullish on the counter. And lastly, Harsh, I'll give it to you for valuation.
Okay, let's have a look at those. Let's quickly pull those up if we can. When you're looking at the price to earnings ratio, the current price to earnings is around 8 times. We won't look at this 1 year forward because it's more difficult to gauge, and therefore let's look at it on a current price to earnings basis, around 7.5 odd times. Its peers, BPCL, IOCL, slightly more expensive, nothing material per se, but maybe 10 to 20% more expensive. But when you're looking at 5-year averages, the 5-year average valuation is at least 20% lower for an HPCL to what it is currently. And it has always traded at a discount to a BPCL and IOCL. And therefore, we're going to give this a neutral, because you're largely in line in that sense with both 5-year averages as well as with history.
And Harsh, I want to point out that we've seen, OMCs have always known for single-digit valuations. We've seen periods in FY 23-24 that the stocks were trading at 3 to 4 times. And a reason why HPCL has always gotten, discount in terms of valuations is because it is the biggest beneficiary when oil prices go lower, because it markets more products than it refines. So that's one of the key aspects I want to highlight. But a neutral picture.
We're arriving at around 5.5 on 8 on our KYC ratings on this one. But, we spoke with Yogesh Patil, who's the Director, Research and tracks oil and gas at Daulat Capital, with regard to HPCL, his views, and how he views this from an investment perspective. Listen in to that conversation.
First of all, the crude prices are near to $63, $64 per barrel. And the HPCL would be the biggest beneficiary out of that, mainly because of, firstly, the gross marketing margins of HPCL, looking into the petrol and diesel side, is in the range of rupees 17 per liter. Okay. But yesterday, there was one development that the oil minister has announced that rupees 2 per liter increase in the excise duty of petrol and diesel. And that will be collected to fund the subsidies which the HPCL or the OMCs have incurred in the FY25. That same collection would be utilized to repay the under recoveries incurred by the OMCs or HPCL in FY25, and that amount was 41,000 crore, closer to that. However, the timing of that reimbursement to OMCs is unknown, or HPCL is unknown. And the OMCs, as per our understanding, they are still waiting for the official notification from the oil ministry. The only point that they will start accounting once they will receive the official notification. Secondly, there is one more development yesterday. Domestic LPG cylinder prices increased by 50 rupees per liter. And that is a positive for the HPCL. Under recoveries will decline rupees 3.5 per kg, or closer to 10,000 crore less under recoveries for FY26 period for the OMCs, and HPCL will be the beneficiary out of that. So they have also mentioned that the MOPNG will revise the LPG prices every fortnight or month based upon the international LPG prices. So all in all, these are the two positive developments for the HPCL. Looking into the falling crude oil prices, HPCL will be the beneficiary, biggest beneficiary among the OMCs, because the HPCL is having a higher marketing to refining ratio. What I mean to say, the marketing volumes of the oil products are much, much higher compared to the refining throughput of the HPCL.
Yogesh, but the latest excise duty hike, it's not going to be passed on to the consumers. So it's going to be absorbed by the OMC. So does this kind of offset any benefit it would get from the lower crude prices?
Yeah. So in the last 3 to 4 trading sessions, what we have seen the crude decline from 75 to $64 per barrel. That indirectly implies that the gross marketing margins or the integrated margins of the OMCs or HPCL has improved by a 5 rupees per liter. In general, what we calculate $1 per barrel decline in oil prices implies a 50 to 60 paisa per liter improvement into the integrated margins of the HPCL or OMCs. So that's one benefit. Secondly, as you mentioned rightly, that whenever there is an excise duty increase, and as of now, that has been absorbed by the OMCs. But sitting today, considering the today's crude prices, the HPCL and the OMCs are earning a super normal gross marketing margins on the sale of petrol and diesel. So still there is enough cushion for the HPCL for the better earnings prospectus of the company.
Got it. And now we know that, this excise duty revenue accretion for the government will be going for LPG, compensation. So what's the kind of compensation that HPCL needs for FY25? And could this be the same cycle that we see, for years coming by? They see losses for the first 9 months, it's reported, and then they just keep on getting compensation.
So good question. So your question was quite straightforward. These 2 rupees per liter kind of excise duty increase will collect approximately 35,000 crore in FY26. Now coming back to the HPCL portion or the share in FY25, as per our calculations, the HPCL has incurred the closer to 11,000 crore kind of under recoveries on the sale of domestic LPG. What we believe out of this 35,000 collection in FY26, the HPCL will receive closer to 9,500 crore, and that would be a net cash inflow to the HPCL. Net cash inflow will lead to the increase in equity value of HPCL, and what we expect that would be in the range of 30 rupees per share for the HPCL.
Got it. So, amid all of this, how do you expect HPCL to perform in Q4 and FY26? What kind of integrated margins are you building in?
FY24, FY25 or Q4, FY25 is already over. We have released our preview report also. In that, we have mentioned the OMCs and the HPCL will post the weaker set of number, mainly because of 3 reasons. First of all, during the Q4 FY25, Singapore benchmark GRM was a weaker $3 per barrel compared to the long-term average of $6 per barrel. That's one reason. Secondly, gross marketing margins were lower compared to the Q3 FY25, which were lower around 3.5 rupees per liter. And thirdly, looking into the inventory losses, there will be a slight inventory losses on the crude and the product side, which will again hurt or impact at the EBITDA level. Lastly, touching to the subsidy, exactly looking into the last year FY24 compared to the Q4 FY25, in FY24 we haven't seen any kind of LPG under recoveries, so that will also impact in a Q4 FY25, considering HPCL will have a closer to 3,000 crore kind of LPG under recoveries during the Q4 FY25. So the numbers for the Q4 FY25 HPCL would be a weaker on Q1Q and YY side. But what we expect in Q1 FY26 and Q2 FY26, sitting today, gross marketing margins are super normal level, even despite an increase in excise duty 2 rupees per liter, that are in the range of 15 rupees per liter. That will definitely boost up the Q1 FY25 earnings. Secondly, GRM is on a recovery mode. Yesterday's closing Singapore benchmark GRM was a $4 per barrel. And yeah, there would be some gains because this excise duty has increased. That will also lead some gains on the oil products. Definitely, it would be a positive result as compared to the Q4 FY25.
Got it.
With that, completely out of time on this edition of KYC. From Mihika, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.